With a massive decline of more than 40% over the last few months, many seem to wonder if Tesla has fallen off the horse. If so, should you go all in now, or is this the end of Tesla? I will answer that question in the next 10 minutes while giving you a fundamental analysis of Tesla. If you stay to the end of this video, I will even give you the same analyzing tool that I'm using for free. You find a link to the tool in the description below, and please remember that nothing in this video should be considered financial advice. Before we dive in, hit the like button, and let's try to get 30 likes on this video. Tesla was the first successful electric car manufacturer in the world. The early years of the company were often rocky though, with difficulties in financing and lots of staff turnover. But despite those rough early years, the company came out strong with the release of the original Roadster. Their cars revolutionized the whole motor industry and made almost every traditional car company transition to the electric world. In July 2020, Tesla actually became the world's largest car manufacturer in the world by market cap. So, why do I ask, is this the end of Tesla? Well, it's a combination of multiple factors. First, the competitive advantage Tesla has had since the beginning is perhaps now deteriorating. This becomes more obvious when looking at the recent Q2 numbers from its competitors. Tesla managed to sell 564,000 cars globally in the first half of 2022, a growth of 46.3% year over year. An extraordinary increase, especially considering that there have been problems with the supply chain. However, the more unknown competitor BYD in China grew 314% in the same period. A sale of 641,000 cars sends a powerful signal to Tesla. In addition, BYD claims its new Blade battery is a game changer, with research backing the claim that their battery is one of the safest and most durable in the market. Meanwhile, the more traditional car companies like Volkswagen, Ford, and Audi are making great progress on the battery front, as well as making cars of better quality than Tesla. The second factor is related to Elon Musk himself. The recent scandal with Musk backing out of the Twitter acquisition has led to Twitter filing a lawsuit. They have hired Wachtell, Lipton, Rosen & Katz LLP, the most profitable law firm in the world. Experts say that this lawsuit could be expensive for Musk personally, and it could potentially mean that he would have to sell some of his Tesla stocks. All of this creates uncertainty, and uncertainty is not good for any public company or market. And last but not least, the current state of the world is not pleasant. The inflation rate is running rampant, which causes the Fed to raise the interest rates to new heights. There's also war in Europe, power supply shortage, and supply chain problems. Musk stated in late June 2022 that he was worried about keeping Tesla out of bankruptcy because the big money furnaces caused by the supply chain issues. Because of fear of a coming recession, Musk also revealed that Tesla is set to trim 10% of jobs and pause all hiring worldwide as concerns about a recession grow. On the opposite side, many consider Tesla not only to be an auto manufacturer, but a tech company in the same league as Apple, Google, Amazon, etc. This means that their service and product expand to more than just cars, and comparing Tesla to other auto manufacturers would therefore not be justifiable. Besides, Musk has already sold a lot of Tesla shares and did so at the peak back in 2021, indicating that he has cash reserves for the coming lawsuits. And lastly, Tesla has been in many unfavorable situations before, but the difference now is that they already have a significant foothold in the auto sector, making it less likely to fail. This is especially clear when looking at the recent Q2 reports, where they increased revenue with a remarkable 42% year on year. Before I go into depth about Tesla as an investment, subscribe to Profit Protection and give this video a like. Okay, so to answer the question of whether Tesla is a worthy investment case now, we have to look at primarily two instruments. The first is calculating the intrinsic value of the company by looking at its key fundamentals. This is the same way of analyzing a stock as the Oracle of Omaha, Warren Buffett, does it. Buffett has stated several times before that he's not a fan of Tesla, but using his way of evaluating a company along with our own look at the company's future, we can determine if there are any long or short opportunities. There are mainly three important principles to have in mind when using his method. Principle number one is the company's performance, measured by the metric called revenue over earning, ROE. It reveals at which rate shareholders earn income on their shares. Tesla has an ROE of 28.9% as of July 24th, well over the industry average of 15.86% in the first 3 months of 2022. The second measurement that is important for any value investor is the company's debt. One way to evaluate if a company has high or low debt is by calculating the debt to equity ratio, D to E. It is considered good if the ratio is between 2 and 2.5. Any higher would mean that the earnings are generated from debt, not from the shareholders' equity. This is usually very concerning, especially during times like these. While lower debt levels do not necessarily mean that it's all sunshine or rainbows, but under circumstances like these, it could be considered acceptable. Tesla's D/E ratio is at 0.14 right now. The last key characteristic Buffett utilizes when analyzing a company is called profit margin. This is a calculation of how profitable the company is. It is not only important to have a high profit margin, but constantly increasing it. Tesla has managed to do so over the past 5 years. By utilizing these metrics and others that would take a lot of time to explain in depth, we can calculate the intrinsic value of the company. Luckily for you, we have made a tool that does this automatically when writing down the ticker symbol of any company listed on NASDAQ. It calculates the discounted cash flow, relative value, and a combination of both. The base scenario of Tesla indicates an intrinsic value of $625 per share. Meanwhile, the worst case scenario suggests a minus 39% decline from today's price of $816 per share. The best case scenario sets a price target $817 per share. So, what about the second instrument to check out before investing? Well, this may be surprising to you, but if you are basing your decisions on fundamentals, but in my view, you should also look at technical indicators. This is just another way to assess whether a stock is oversold or overbought. If both the intrinsic value and the technical indicators are pointing in the same direction, it could be considered a good investment opportunity. Luckily for you, I've got you covered. For the last 3 years, I've developed an indicator giving you an answer to this. Just to be cautious, the indicator is still in beta, but it triggered a buy signal on the 15th of July. As we discussed, based on our fundamental analysis, the share price of Tesla seems attractive, and even the technical indicator signals a buying opportunity just a couple of days ago. But taking the intrinsic valuation of Tesla in consideration, we get a totally opposite picture. In my view, Tesla is therefore a risky investment for now. Remember, the fundamentals and the technical indicators are not always pointing in the same direction, since they do not include other relevant metrics like the macro perspective and the competition. You have to make up your mind on whether Tesla is a good investment for the long term. If you are curious about a potential 2,700% profit from just one investment, you can check out this video.